fund and cost of each resources, then we also figured out the reason why we consider the cost, even if we use the retained earnings, right? So opportunity cost, due to the opportunity cost, even if retained earnings is the retained within the company, but if we spend the retained earnings, then we should consider as cost, okay? So we figured out RD and RP in a more easier way, and we figured out RS. So there are two ways to figure out RS. And the last issue about cost of capital is RE, right? So as I told you, originally this should be RC, right? RC can be decomposed of RS and RE. This is the cost of equity, capital or equity. So this is the cost of retained earning. This is cost of new common equity, right? So today we will compare RS with RE. So originally that should be RC, but the reason why we use RS instead of RC is because RS is more popular. Why? I will let you know, okay? So we figured out RS. There are two methods to calculate the RS, right? CAPM or dividend cash flow method, right? So we already figured out how can we solve RS. And RE is the cost of new common equity, So why is the cost of retained earnings cheaper than the cost of issuing new common stock? So basically, RS is cheaper than RE, generally. So why? When a company issues new common stock, they also have to pay flotation cost to the underwriter. Flotation cost equal to issuing cost to the underwriter. The most popular underwriter is IB, investment bank. When we talk about the financial institution, we already figured out in investment bank or security company. Okay, so underwriter, we already figured out the role of underwriter. So if company want to issue the securities, then generally they do not issue the security by themselves. Instead of the issuing by themselves directly, they ask the issuing work to IB, underwriter, right? So once underwriters buy all of the security, and then underwriter resell the security to the public. So that's the underwriter's role. So underwriter can make the decision, the size, the period when is the most appropriate time to issue the new security, what price is the best price when they issue the securities, how many securities we should issue. Those kind of things are very important in the issuing the new securities. So generally, rather than the company itself, the underwriter, the representative of underwriter is IB investment bank or security company here in Korea, play a role as that kind of the things, right? So the company who want to issue the new security should pay the the flotation cost to the underwriter. So that's gonna be cost. So the cost of new common stock is higher than cost of the retained earnings, right? So that's gonna be additional cost. So if we issue the new securities, we should pay additional cost, which is the flotation cost. Or issuing new common stock may send a negative signal to the capital markets, which may depress the stock price, which means if the company has the enough money, sufficient money, then the company don't have to issue the new securities to raise a new fund, right? So it's only you can they can use the retained earnings, right, within the company. So the reason why the company issued a new stock is what? There is no sufficient money to reinvest in some project, right? So if the company issued a new securities that which affect the negative signal, bad signal to the market, capital market, then stock price goes down. Then what happened of the cost of equity? So the one of the method to calculate the cost of equity is if we use the dividend cash flow method, then RS it can be calculated by P1 divided by P0 plus G, right? So as we already figured out in the last class, here you go. RS equal to D1 divided by P0 to plus G. Okay, but if the company not use the retained earning instead of using the retained earning, if the company issue the new securities, then which influence the bad signal in the market to the market, then stock price goes down, right? Stock price goes down, then this RS now is changed to RE because we assume that the company issued new securities, then stock price goes down, then RE goes up rather than RS, right? So denominator is increased, then the figure denominator is decreased, then the figure, I mean the RS is gonna be increased. That's the reason why the RE is higher than RS. Okay. So that's the second reason. First reason, we need to consider the cost to pay the underwriter. Second reason is reflected in the market. The market reflection, bad signal. Right? Then, if the company issues a new stock, then the market participant recognize those kind of things as the negative signal. Then stock price goes down, then the cost of equity, cost of new common stock goes up, right? Here's the example. If issuing new common stock incurs a flotation cost of 10%, so if we assume that the flotation cost is 10%, then what is the cost of new common equity? So other things held constant. So in previous example, we already figured out RS is the 13.4%, right? Both if we use the DCF or CAPM, we figured out RS is 13.4%, 13.4%. Then what happened if the cost of flotation cost is 10%, RS was the 13.4%, right? So if we consider the flotation cost of 10%, then the stock price times 1 minus F. F is the percentage of cost, the flotation cost. So if we solve this equation, RE is gonna be 14%. Definitely a price is gonna be a decrease, right? The flotation cost play a role as the denominator decrease, okay, decline of denominator. So RE is 14%. So RE is 14%. So RE is a little bit higher than RS due to the previous reasons, right? So here is the example of the calculation of the RE, right? So flotation cost is depends on firm's risk and type of capital being raised. So flotation cost the highest for common equity. So the flotation cost when issued a common equity is higher than the flotation cost when issued a bond, right? So the common equity's flotation cost is highest comparing to other financial instruments. However, since most firms issue equity infrequently, the per project cost is fairly small, right? So generally the company use the retained earnings. Then if they, the shortage of the money, if they use the retained earning completely, and then they may be able to issue the new common equity, right? So that event occurs infrequently. Okay, so even if we have the flotation cost, but when we calculate the RE or RS, we ignore those kind of cost. That's because the originally there should be RC, right? So as I told you, RC is not equal to RS, right? RS is one factor or component of RC. So RC can be decomposed into RS and RE. But as I told you, generally we ignore RE. So we use RS instead of RC. All right. So originally that should be RC, but the reason why we use RS is because RE has the little the meaning, right? So we can't ignore RE. That's because we use RS instead of RC. All right. So if you say a cost of equity, then we will say just RS because the flotation cost it's very rare the to issue the new common the equity. All right, that's the flotation cost. So we will frequently ignore the flotation cost when calculating the WACC. So if we ignore the flotation cost, then what is the capital structure? What is the firm's WACC? It's the WD, WP, WC is the target capital structure. As I told you, this is not optimal capital structure. It's not current capital structure, but target capital structure. It should be target capital structure. So if we assume the target capital structure is the 45% of that, 53% of equity, 2% of preferred stock, then this is the 45, 53, 2% based on target capital structure. And cost of that is 10%. And we should consider the tax deductible effect, right? Tax deductible, as I told you, tax deductible effect. And WP, RP is the preferred stock, cost of preferred stock. RC or RS is the 13.4%. So we ignore 14% of RE, right? So if we calculate this one, WACC is going to be 10%, right? 10%. So we figured out WACC of 10% with the example. All right. Then next topic is then what kind of factors to affect the WACC? And some factors cannot be controlled. Some factor can be controlled, right? So market, for example, market condition cannot be controlled by us, but the firm's capital structure or dividend policy can be controlled by us or firm's investment policy. Okay, so for example, market condition means, for example, if the market interest rate is increased, then RD is increased, right? So the market interest rate can affect the cost of debt directly, right? So cost of debt is increased, then WACC is increased. Okay. Another market condition is suppose, for example, stock price decrease. Then as you see, RS is increased. Then WACC is also increased. That's the market condition. This market condition cannot be controlled by us, right? Whereas firm's capital structure or dividend policy or investment policy can be controlled by us. For example, capital structure. So, for example, if the weight to raise a fund by using debt is increased, then what happened? WACC is what happened in WACC? 가기, 당가기.
네.
Yeah, if the weight to raise a fund by using debt is increased, WD is increased, then what happened in terms of WACC? WACC increase or decrease?
Increase.
WACC increase? Increase or decrease?
Increase.
You said increase, right? Increase or decrease? The reason why I'm asking twice, 3 times, 4 times is because
Maybe.
I'm giving hint. So weight to raise a debt is increased, then WACC is increased or decrease?
Decrease.
Decrease, right? Exactly, you're right. Decrease. Why is that? See, WACC is here. You go, right? WACC. Okay. Then, as you know, stocks return, common stock return, stock return is higher than bond, right? Stock is riskier than bond, so generally stocks return is higher than the bonds return. If we decompose into two parts, stock, common stock and preferred stock, then definitely common stocks return is higher than preferred stocks return. If we change our perspective, not from investor, but from company borrower, then R, E, R, RS, RP, RD. Then which one is higher? RS is higher than RP, RP is higher than RD, right? So if WD increase, then cost of debt is cheapest comparing to other resources, right? So if the RD is increased, then WACC is decreased, right? But it's not necessarily, all right? It's not necessarily. So if x-axis is the WD, weight to raise a fund by using debt, y-axis is WACC, then weight to raise a fund by using debt, as weight to raise a fund by using debt is increased and WACC decrease, okay? Until some point, after some point, WACC may rebound to, toward upward, right? Go up, because why? Default risk. So until some point, it's okay, right? If we increase the cost of, the weight to raise a fund by using debt, but if the WD exceeds the threshold point, then what? The likelihood the company is bankrupt is dramatically increased, right? So if the debt ratio is increased, debt ratio is exceeds the threshold point, then the probability that the company is bankrupt is dramatically increased. Okay, So WACC decreased gradually as the cost, the way to raise a fund by using that. Then if the way to raise a fund by using that exceeds some point, then the WACC increased dramatically. So this the slope is steeper. The going up slope is the steeper than the going down slope, right? Just like that. So we will talk about this kind of thing in chapter 15, last chapter that we covered this class, capital structure. In capital structure class, we will talk about this issue. Okay. So anyway, if the capital structure is changed, then the WACC is also changed. For example, if the way to raise a fund by using that is increased, then the WACC is the decrease, right? Decreased until some point. How about if we dividend payout ratio is increased? Dividend payout ratio is increased. If the dividend payout ratio increase, then what happened? WACC is increase or decrease? Mark. If the dividend payout ratio increase, then what happened in terms of WACC? Increase or decrease?
Increase.
Increase, exactly, increase. Why is that? As I told you, this is the pie of profits. So if we, provide the 30% of earnings to the shareholders as dividend, then we can use the 70% of the earnings, right? But the dividend payout ratio is 30% in this example, right? But if the company increase the dividend payout ratio till 50%, for example, 50%, the half of our profit can be paid to the shareholders as dividend, then total size that we use for reinvestment is shrink, right? From the 70% to 50%. So it's gonna be the shortage of our fund. Then the company cannot but issue new security, new stock. Then, as I told you, RE is higher than RS. So dividend payout ratio is increased. Then we cannot but use issue the new common equity, which the cost of new common equity is higher than the cost of retained earnings. So WACC is going to be increased. Okay, so there are some factors to affect the WACC. Another way is investment policy. Another factor to affect WACC investment policy. Firms with riskier projects generally have a higher WACC, higher risk, higher return. Investment policy can be explained by next slide. This one can explain the investment policy. So should the company use the composite WACC as the hurdle rate for each of its project? The answer is not at all. The composite WACC reflects the risk of an average project undertaken by the firm. Average project. Risk is an average project. Therefore, the WACC only represents the hurdle rate for a typical project with average risk. So the WACC we figured out can be used as hurdle rate for a typical project with average risk. Typical project means has the average risk. Okay, so different project have different risk. Different project has different risk. Right? So even if project can be conducted by the same company, but the WACC to be used is different depending on the project's risk. Okay, so the project WACC should be adjusted to reflect the project risk. Should be adjusted to reflect the project's risk. So Let's take a look at the figure 11.2, page number 4 to 4. 4 to 4, 11.2. So here you go. X-axis is the risk. Figure 11.2, page number 4 to 4. Y-axis is the return, rate of return. Return is same as cost, right? Return is same as cost. Return from the point of the investor, cost from the point of the borrower. Okay. So if composite WACC is 10%, we figured out the WACC is 10%, right? Composite WACC is 10%. We figured out. Okay, we already figured out 10%. So if this is 10%, right? This is composite WACC, 10%. Okay. Let's say there are two divisions within the company. So division L and division H. So as you can imagine, division L generally, manage the lower risk project, whereas division H manage the higher risk project, let's say, right? So if project L's return is expected return is 9%, for example, this is the low risk. So this X is the project L's conducted by L division. Okay, so L division manages the project L. Project L is the low risk, and the expected return of project L is 9%, for example. Whereas the project H conducted by H division, they expect the 11% of rate of return. 11% of rate of return, for example, right? Okay. Then composite WACC play a role as cost, right? Cost. WACC is cost, right? And this X display what? Return, expected return. Okay. Then if you are rational thinker, rational decision maker, this is project L and project H, then project L should be accepted or rejected. 준성, project L should be accepted or rejected.
I think it should be accepted.
Accepted? Accepted?
No, I think it should be rejected.
I'm giving the tip, right? So this is the cost, right? This is the return. So return is lower than cost. So this should be rejected, right? How about the project H? 정호, project H. Project H expected return is 11%. Project H cost is 10%. This project should be accepted or rejected? Accepted, yeah, accepted. This one should be accepted. So if we use the composite WACC as the hurdle rate, in that context, hurdle rate is cost. Then project L should be rejected, whereas project H should be accepted. Okay, but as you can see in page number 424, if divisions WACC is 7%, division L's WACC is 7%. Okay, division H's WACC is 13%. 잘 그려야 될 텐데. 에이, 잘 못 그렸다. 그렇다고 쳐. 어? 다시 그릴까? 아, 이거 못 그리네. 아무튼, 오케이. 다시 그려. Retry. 그냥 안 돼. 이게 마음대로 안 돼. 펜이. 기준 같다. 오케이. So, if the black line is real WACC, reflecting the division's risk. So this is division L's WACC is 7%. The division H WACC is the 13%. For example, this is the 13%. And now let's think about whether or not we accept the project. So if we use not composite WACC, but division WACC displayed as the black line, then now project L is accepted or rejected. 준석.
I think it should be accepted.
Accepted. So if we use the not composite WACC, but the division WACC displayed as the black line, then project H should be accepted or rejected? Rejected. Okay. So we changed our decision from reject to accept in project L, from accept to reject project in project H. Okay, so each project has different issue, different the risk. Okay, so different project have different risk. So if we make the decision, we should use not the composite WACC, but the division WACC, right? Division WACC. So each project has different risk. So we should calculate those kind of risk, reflecting the the project risk. We should calculate WACC of specific project reflecting the risk, right? That's the last issue in the chapter 11, cost of capital. Any question? Cost of capital? So, okay, then let's go to the chapter 12. Chapter 12, Basics of Capital Budgeting. Should we build this plan? So, in the past, I think until 3 or 4 years ago, financial management class has the team project. So the team project is the capital budgeting. So if you can select some company with the real the project, so you can make the decision whether or not you should accept or reject, which was very interesting. But you guys dislike those kind of team project, and you guys dislike me either, so I stopped to give the project. So now you don't have any team project in the financial management class, right? So anyway, capital budgeting is very important thing to maintain sustainability of the company, especially sustainability. Okay? So there's no company to continue ongoing forever, right? So the capital budgeting is let's take a look at the capital budgeting definition of capital budgeting first in page number 438. As long as I remember, I explained the basic knowledge of capital budgeting in the first class when I explained the syllabus, right? So let's take a look at the page number 438, putting things in perspective. Third line, while a budget, so in the last chapter, first line, we discussed the cost of capital. Now we turn to investment decisions involving fixed assets or capital budgeting. Here, in capital budgeting, here capital refers to long-term assets used in production, while a budget is a plan that outlines projected expenditures during some future period. Thus, the capital budget is a summary of planned investments in long-term assets. And the capital budgeting is the whole process of analyzing projects and deciding which ones to include in the capital budget. Right? So in one word, capital budgeting is the investment decision with huge amount with long term, right? So in this chapter, we will figure out the definition first. Definition first. And we will discuss the steps to capital budgeting. There are 5 steps to finish up the capital budgeting, 5 steps. And we will classify the project with independent or mutually exclusive. And we will talk about the method to make decision. NPV, you've heard about it, right? Net present value. IRR stands for internal rate of return. MIRR is modified internal rate of return. Payback period or discount payback period. So we will talk about several ways to estimate the project, right? So what is capital budgeting? Capital budgeting is the analysis of potential additions to fixed asset. This is generally associated with a long-term decision, long-term, at least 10 years. Large expenditures, huge amount of cost, large expenditures, capex, large expenditure, capital expenditure, right? Capital expenditure, capex, capital expenditure. And this is very important to forms future. So basically to continue sustainability of the company, capital budgeting is the most important thing, capital budgeting. So I'm not sure, but I already explained, I told you, right? So Dow Jones Industry Average settled in 1920s, right? With 30 companies, big companies, blue chip. You say blue chip, right? Blue chip. Did I say this one? 설명했죠? 옛날에 설명했지? Did I explain this one already? 해도 그만, 말해도 그만, I don't know what you are saying, I forgot everything. 예. Did I say this one or not? Did I explain this one or not? 몰라, I cannot remember. 넌 떠들어라. You should say something. Okay. So Dow Jones Industry Average is composed of 30 companies set up in 1920s, I think. Now the 100 years after 2021, still Dow Jones Industry Average includes 30 companies. So the companies that are included in Dow Jones Industry Average play a role as the market index, right? Market index, stock market index. This is a 20 nowadays 30,000 something, right? 30,000 something. So Dow Jones Industry Average play a role as the stock market index. And companies that are included in Dow Jones Industry Average is the representative companies on that period, right? So this is the very honor to include it in the Dow Jones Industry Average. So most companies that are Dow Jones Industry Average is the big company, the large, the market capitalization, 시가총액, market cap. So most of the huge companies can be included in the Dow Jones Industry Average. This is an honor to the company. Now let's compare these 30 companies with these 30 companies, right? Then how many companies are still existed in Dow Jones Industry Average as of today? And out of 30 companies included in 1920s, the first settled when the Dow Jones Industry Average was settled down. How many companies are still survive? How many companies? 내가 물어봤던 것 같은데. Paul, what do you think? How many companies still exist in the Dow Jones Industry Average out of 30 companies when the Dow Jones Industry Average is settled down and the companies included in Dow Jones Industry Average? How many companies are still?
Can you repeat slowly, please?
Disconnected 됐다. Disconnected. 예. What did you say?
Is it possible just to repeat a little bit slowly, please?
Okay. So my question was that Dow Jones Industry Average generally include the companies whose market capitalization is the large in that period. Okay, so Dow Jones Industry Average was settled down in set up in 1920. So in 1920s, most biggest companies were included in the Dow Jones Industry Average, 30 companies. Okay, so By the same token, today's the largest 30 companies are included in the Dow Jones Industry Average. So what I'm asking is how many companies are still existed in Dow Jones Industry Average as of 2021 out of 30 companies that are included in the 1920s? That's my question.
Okay. Maybe I think very few, like 1 or 0.
Very few. How many?
Yeah. 1 or
How
0.
many?
1
One
or
or zero. Oh, you are good. Oh, 1 or 0. Yeah. Yeah, you're exactly. So, as time goes by 100 years, I forgot, G or GM, General Electronics or GM, General Motors, were last included in Dow Jones Industry Average. GE or GM was delisted in Dow Jones Industry Average in 2020, June or 2020, June of 2020. The last company that are included in the the 1920s was delisted on June of 2020. So nowadays, nothing, nobody, nothing is existed in the Dow Jones Industry Average nowadays. That implies what? Those things implies that what? Nobody knows what happened in the future of the company, right? So there's no company to manage forever, to exist forever. So to increase those kind of sustainability, the companies should always face some decision whether we go to the new business area, right? So those kind of things can be decided by this capital budgeting. So that's because capital budgeting is very, very important. So the capital budgeting is very, very important decision in the company to extend their sustainability, right? So if you get a job in the company in the department of plan or strategy, then you always do those kind of work, right? So we can go new business area, not 정욱이 빵, alright, 정욱이 빵, 가 말어, 맨날 그거 하는겨. 근데 굉장히 중요한 의사결정입니다. Okay, so very important to firm's future, firm's future. And project classification is page number 439. So there are many types of capital budgeting investment decision. Before that, there's the strategic business plan. So the capital budgeting is also named as the strategic business plan. So strategic business plan is a long-run plan that outlines in broad terms the firm's basic strategy for the next 5 to 10 years, at least 10 years. So that's the strategic business plan. So there are 7 types of capital budgeting, 7 types of investment, project investment. Let's take a look one by one. Accordingly, the firms generally categorize projects and then analyze them in each category somewhat differently. So for example, replacement case and expansion case, we may approach the different way, right? So the decision making is a little bit different, but we need to focus on expansion, especially expansion to the new business area. So let's take a look at the several type of the capital budgeting. First one is replacement. Replacement needed to continue current operations. So one category consists of expenditures to replace worn out or damaged equipment required in the production of profitable products. Okay, so you know, if the current existing the facility to produce production is worn out or damaged, then we should replace, right? So that decision is okay. We need to replace one. That's the replace one. The you know type of replacement capital budgeting problem. Second one is the replacement, but this replacement is to reduce the cost, okay, cost reduction. This category includes the expenditure to replace serviceable but obsolete equipment and thereby to lower cost. So second replacement is what? We still use those kind of facility, but to reduce the risk, to reduce the cost, to lower the cost, we can replace the facility. We should do that or not. That's the second type of decision making. This project. Third type is expansion of existing products or market. Expansion of existing. Still, I mean, even if we produce some the production in facility product line, but it's very boom. So we need to add new product line or not. That's the third type of decision making. Expansion of the existing products or markets. These expenditures to increase the output of existing products or to expand retail outlets or distribution facilities in the market now being served. Fourth type is the most typical one. Fourth type, expansion into new products or markets. So enter the new business area, right? You enter the new business area. Expansion into new products or markets. This investment related to new products or geographic areas, and they involve strategic decisions that could change the fundamental nature of the business. That's the most typical, most popular type of capital budgeting. Expansion into new product, enter the new product. Fifth one is safety and or environmental projects. So nowadays, as we study ESG, right? Environment issue, society issue, out of society issue, safety issue is very important. So this kind of project is another features of the investment, I mean the project decision making, right? And sixth one is other project and merger, something like that. So there are many types of project, capital budgeting project. Then what is steps? What is the procedure to do the capital budgeting? First one is we need to estimate cash flow stream first. Inflow or outflow, how much the flows in, how much flows out. So we need to estimate cash flow. If we start the new project, how much money flows in, how much money we need to spend as capital expenditure, outflow as outflow. So first of all, we need to estimate the cash flow stream. Second one is to assess the riskiness of cash flows. Riskiness of cash flow is just like that. Even if we expect, right, cash inflow in first year, cash inflow in second year, cash inflow in third year, cash inflow in 10th year, cash outflow now, the capital expenditure. But this expected cash inflow, the possibility that our expected cash inflow is realized is not guaranteed, right? So we need to calculate the riskiness of cash flow stream. So what percent that the expected cash inflow can be realized in reality, right? So that's the excess riskiness of cash flow, which means we need to make sure the the cash flow estimated in the first step. That's the second step. Third step is determine the appropriate cost of capital. We already done in chapter 11, cost of capital, right? We already done. We finish up the cost of capital. We finish up the third step. Okay, and fourth step is find net present value, IRR, profitable index, something like that, which is the decision criteria. Okay, that's the fourth step. Fifth step, then based on from the first to fourth step, we can make the decision whether or not we accept. Except if NPV is higher than 0 or IRR is higher than AACC, then we need to accept the project. So third step we already done in chapter 11. Fourth step and fifth step we will talk about fourth step and fifth step in chapter 12. And first step and second step we will talk about in this topic in chapter 13. So 3, 4, 5, and we go back to the 1, 2. That's the procedure. 3, 4, 5, and then we will talk about first and second step. Okay, then we have done this one. So in this chapter, we will talk about the fourth step and fifth step, because this one first step and second step is the more complicated rather than 3, 4, 5 step, third, fourth, fifth step. Okay, so first of all, we need to figure out 3, 4, third, fourth, fifth, and then we go back to first step. All right. And let's before we talk about the net present value or IRR, we will figure out the basic feature of the project. So project may be independent project, or project may be mutually exclusive project. So independent project means if the cash flows of one are unaffected by the acceptance of the other, then we would say that those kind of projects are independent. So independent project, so if the projects are independent, then we can choose more than one project. Okay, we can choose the multiple project. If the projects are independent each other, whereas if projects are mutually exclusive, which means if the cash flows of one can be adversely impacted by the acceptance of the other, so one cash flow of one project can be adversely impacted by the acceptance of the other, then we should choose only one project. Okay, one project. If projects are mutually exclusive. So if the projects are mutually exclusive, then we should choose best project. Okay, best project. If projects are independent, then you can choose multiple projects that are satisfied with the decision criteria. Just like if the NPV is higher than 0 or IRR is higher than AACC, then we choose all kind of projects that are satisfied with this condition. If projects are independent, but if projects are mutually exclusive, then we choose only one, the best project that are satisfied out of the project are satisfied with this condition. Okay, if the three projects are satisfied with this condition, but we should choose the best project out of 3 if the projects are mutually exclusive. But the project are the independent, then we can choose all of them. 3 projects are satisfied with this decision criteria. Okay, so from now on, we will talk about mutually exclusive project. Mutually exclusive project, not independent project. So from now on, all projects that we talk about is mutually exclusive project. And all the project may be decomposed into normal cash flow stream or non-normal cash flow stream as well. Normal cash flow stream is cost followed by a series of positive cash inflows. So the one change of sign, just like cash outflow first, cash outflow occurs first as capital expenditure, and then cash inflow continue. Right? Cash inflow happen. Okay, so only one time to change the cash flow, cash outflow to cash inflow, just one time, right? Those kind of cash flows, if project display those kind of the cash flow stream, we would say this is the normal cash flow stream. Okay, normal cash flow stream. So cost negative cash flow followed by a series of positive cash flows, one change of sign, whereas non-normal cash flow stream means two or more change of signs. So just like cost outflow, cost inflow, cost inflow, cost outflow, cost inflow, cost inflow, cost outflow. Not of course cash. Cash outflow, cash inflow, outflow, inflow, inflow, outflow. Then one time, twice, three times, four times change. So if the two or more change of signs of cash flow, then you say those kind of things non-normal cash flow stream. Most common is just the two times, right? So cost happen first, negative cash flow, then string of positive cash flow, and then cost close project. So just like cash outflow, inflow, cash inflow, cash inflow, cash inflow, cash inflow. When we close a project, cash outflow. For example, nuclear power plant or strip mine, extra, right? So if we close, when we close the nuclear power plant, we should pay something, right? We should pay expense to close, to destroy the nuclear power plant. So there's that the associated with the cash outflow, right? Another example is strip mine. Strip mine is the mine, right? So if we close the strip mine, we also spend some money to close the those kind of the 광산, strip mine, 광산, right? So the cash flow stream may be normal cash flow or non-normal cash flow. The reason why we distinguish cash flow stream just like normal and non-normal is because if you want to use IRR, normal cash flow stream, in normal cash flow stream, it's okay to use IRR. But if the project present the non-normal, then if you use the IRR, then the result is gonna be very weird. Okay, so that's because we need to separate, we need to distinguish normal or non-normal cash flow stream. IRR, when we use the IRR, right? As you shall see. So when we talk about IRR, I will let you know very detailed. So, and decision criteria and PV IRR, modified IRR, payback period, discounted payback period. We will talk about this issue this coming Thursday. Okay? Any question? So as I told you, even if your performance is not good as much as your expectation, but you can sufficiently recover if you study hard in the second half of this class, because the second half of the contents that we are talking about, the second half of this course is, as you know, is the relatively the complicated, tougher than the first half. So you are sufficiently can sufficient you can recover sufficiently if you study hard. Okay. All right. If you don't have any question, then let me stop here. Bye. Virginia, we'll talk. Some more talk.